Hello, this is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So glad you're here. This is the Accounting Superstar channel. Hey, I've got a website here that's got all my videos organized. It's called accountingsuperstars.com, and if you go there, it'll be really easy for you to find videos on accounting for the topic you're looking for. So today's lesson is for students who are in their very first accounting class, probably about their 5th week of class, and studying retail stores, accounting for retail, and trying to figure out cost of goods sold. So here we go. Here's the lesson for you. This is the 3rd lesson. And so if this one's a little complicated, go back to lesson number 1 and 2, and you can find them on accountingsuperstars.com. All right, so here we go. Inventory, January 1st, 2001, $9,000. Now, folks, we are using the periodic inventory system. So what that means is periodically the people in the store count their inventory. And when that is the case, then on your trial balance, your inventory listed on your trial balance is your beginning inventory. So that is beginning inventory, whether it says it or not, periodic system, beginning inventory. So coming down the list here, here's some other accounts from our trial balance that we will need. We will need purchases. Purchases is reserved for purchasing inventory, things that we're going to turn around and sell to our customers. Purchases doesn't mean purchasing anything, like purchasing a pickup truck or whatever. Now, the next account here is purchase returns allowances. These are things that were the wrong size, wrong color, they were broken. We didn't like them, so we sent them back. And purchase discounts is, that is when we pay our bill early and the vendor gives us a discount. And these discounts add up. They're worth taking. So what we have here is purchases as a debit. We've got purchase returns allowances as a credit. Purchase discounts as a credit, so we will subtract those two. And lastly, we've got freight in for $60,000. Now, if you notice that purchases and freight in are debits, we're going to add those two together. So add purchases, subtract the purchase returns allowances, subtract the discounts, and add the freight in. So there we go. Now, never, ever, ever include freight out or delivery expense. It's only freight in that we're going to include. So coming down to the last thing that we need here our ending inventory. And here's something that's going on, folks, that we've got something else here. The estimated returns inventory is estimated to increase by $1,000. So, folks, what's going to happen is we sold a lot of inventory, and some of it, not very much, but some of it is going to be returned. Customers won't like it. It'll be the wrong size. It wasn't what they expected, so they're going to return it. So a good retail store here will estimate those returns and take them into account. And so what we'll do is, since the estimated returns inventory is estimated to increase, we're going to take that away from our cost of goods sold. All right, so here's our basic formula. And again, this is using the periodic system. Beginning inventory plus purchases minus ending inventory is cost of goods sold. Memorize that. You're going to use it a lot in this class, and if you take managerial accounting next semester, you're going to use it even more. So just remember that formula. And that's the formula that I remembered. I don't memorize this expanded formula. It's too much to remember. But what I do is I remember the basic formula, and from the basic formula I can figure out the more expanded formula. So here we go. I'm going to get this down a little bit more. Here we go. And what I'm going to do is split the screen a bit. Here we are, and that way I can find the accounts. So the first account that we need is the beginning inventory off of that trial balance. So all you do is go up here to the trial balance. There it is, $9,000. So let's plug $9,000 in there. And then the next thing is we need that account purchases. Here we go, purchases. It's going to help us figure out cost of goods sold. So here we are, purchases $325,000. Let's drop it into place. And then we're going to subtract away purchase returns and allowances. Here we are, subtract away that $25,000, and we're going to subtract away those discounts that we got. It's very important to take advantage of those discounts. They are well worth it. And then we're going to add in the freight the shipping cost. And this is just going to be a little subtotal here. All we're going to do is take the 325 minus away 25,000 minus away 10,000, add 60,000, you get 350,000. So that's the net amount purchased. Inventory available for sale? Well, that's easy. All we're going to do is take the beginning inventory plus the cost of goods purchased, add them together, and there you are, right there. It's just that easy. Now let's subtract away the ending inventory. So the people in the store counted their ending inventory and they counted $12,000. So here we go, we'll subtract that away. So the next line here is cost of goods sold before estimated returns. Well, that's easy, folks. We take our inventory available for sale, minus away our ending inventory, and that'll give us our cost of goods sold before the estimated returns. And then what we're going to do is we are going to subtract away this $1,000. And you might be thinking, well, why are we subtracting that away? Well, the reason why is that the store is estimating, they're guessing, based on past experience, that there will be some customers that don't like their merchandise. They don't want to keep it. It was the wrong color or the wrong size, and they're returning it. Now, right at this point in time, this is all an estimate. The store doesn't know who's going to return things or what's going to get returned, but based on past experience, probably about $1,000 will be returned. So what we'll do is we'll take that $1,000 and we're going to deduct it away from the cost of goods sold. We're going to have it reduce the cost of goods sold. Find the cost of goods sold. All we do is take the cost of goods sold before estimated returns, subtract away the increase in estimated returns inventory, and we have cost of goods sold. So here we are. There it is, $346,000, and there we go, folks. So one more time. I don't memorize that expanded version, but what I do is I've got this small little formula memorized. It's really easy. Memorize that, and if you memorize that, it'll help you figure out this expanded version here. I never try to memorize this big version. All right, folks. Well, if this video helped you out, let me know. Hit that subscribe button, hit that like button. Also, check out accountingsuperstars.com to find a listing of these videos. And let me know what topics will help you out. Let me know what topics are giving you a bad time, and I'll make a video and help you out. So until next time,